Krishna Kumar Karwa joins us. Let's take a conversation forward. KK, good morning. Thank you for joining us. KK, every day we try and find a new adjective which can describe the market strength. And every time we try and find that new word, we have to replace with another stronger word. This bull market has surprised everybody. It has surprised everybody both in terms of pace and in terms of size. How does one deal with this kind of enraging bull market? How does one participate in this bull market? How does one make money in this bull market?
Good morning, Nikun, and thank you for inviting me to the show. Yeah, Nikun, you have rightly said that this is a raging bull market, and how does one make money? I think it's very, very simple. I think it's all about patience. I think the way the markets are poised is not only a function of what the corrections we saw maybe a year ago, but more than that, the kind of growth that the Nifty earnings is expected in the current year and the next year, which is around 30-35% kind of growth that we expect in the earnings for Nifty for the current year and say 15-17% for next year. Valuations may be slightly richer than normal, but the thing is that if you look at bottom of basis, the various sectors, every sector seems to be having a tailwind. So investors need to be just staying invested. There would be times when some of the sectors or portfolio stocks would be underperforming. So there is a kind of rotation which keeps on going, right? From small mid cap to large cap. So we have seen that initially for the first 6-7 months, you had the small mid cap outperforming big time. But in the last 1.5 months, the large cap indices have caught up. So I think a minimum churn in the portfolio and holding on to your winners, that's the trick about staying invested in bull markets. And I think there will be more volatility. So there will be many global macro reasons to let go of stocks. Sometimes you'll have taper tantrums, sometimes you'll have oil prices moving up, inflation fears, some geopolitical challenges. I mean, these are things that it's very difficult to predict. So I think staying invested is the key thing. And when will be the time to take money off the table? I think it's all going to be on the bottoms of valuations where possibly you feel that most of the juice is out and maybe FY24 is kind of getting discounted. Or if you are a very strict follower of asset allocation, when equity part of your portfolio goes beyond what you want as a part of risk management, that's the right way to take money off the table.
KK, earnings have surprised and they've delighted everybody. In a bull market, for markets to keep on going higher, earnings surprises have to be there. How does one figure out that earnings they will surprise us, or the surprise part or the growth part is already factored in?
Yeah, I think our markets are very well analyzed. For every large cap stock, maybe there are more than 20-30 analysts who are covering the stock. So far, we have in the first quarter results also, we have not seen too many earnings downgrades. And in fact, there have been more upgrades than downgrades. So I think that is one way to keep a track of earnings expectations versus what actual delivery is happening. That's the simplest way of going about it. But even then, I think there are some sectors where possibly there is a scope for massive earnings upgrade in the coming 12 to 15 months. And some of those sectors could be invested in. But coming back, I think, yes, earnings have been discounted. We are giving higher valuations. But the interest rates are being very low. So I think we have to give that higher multiple to the markets also.
When you say that you think that there are pockets of earnings surprise, which are those pockets?
See, I believe at the current environment, if you see the first quarter numbers, probably the financials were the one where we had the massive credit provisions being much more higher than expected. My sense is that the collections now are very robust. That is one segment where we have still not yet seen the benefit of credit growth coming in. So maybe the second half of the year, we should see massive credit growth pick up as the economy picks up. and maybe quarter two, you should possibly see credit costs being muted. I think that is one segment where we believe that there could be very positive earnings upgrades going forward. Another segment where there is a massive tailwind is the whole mortgage finance. The cost of funds are very low for most of the housing finance companies, and they are seeing massive growth in the sanctions and disbursements. So there possibly you could see that once the quarter two, quarter three numbers come out and people see the momentum, maybe you could possibly see some earnings upgrades coming over there. So this is one segment, and even the real estate segment also, which is mortgage finance, forms part of that chain. The whole real estate segment and the build, that seems to be in a very sharp momentum. And for the size of the market, the valuations of most of the real estate companies on an aggregate basis, I think the real estate companies are totally valued at some $30 billion. For our market, for our size of the country, possibly that's a peanuts versus what it should be. So maybe that is one segment where we should see a lot of positive momentum.
All right. Hi, Mr. Karwa. This is Mubina as well joining in. So banking is one segment where you believe that the provisioning has been pretty conservative in the quarter gone by, and as collections improve, we should see sort of an improvement come by. What case would you also make in terms of how to pick and choose banks? Because, you know, today banks is not just one coterie of stocks. You have the large private banks, you have small finance banks, then you have the smaller private banks as well. So if we are looking at things like, you know, provisioning, like you mentioned, quality of the book, and then let's not forget, we are expecting credit growth as well to pick up as the economy continues to recover. What bank would be best placed to capture all of these positive points?
Yeah, I think I believe that the credit growth pickup will be first seen in the larger banks, and then it will trickle down to the tier 2, tier 3 banks. So one is, if you're looking at pure growth, then possibly you will see the larger banks first off the block. But having said that, the valuations of the larger banks are also relatively rich. So there are a few mid-sized private banks where possibly the credit growth has been poor, or rather the credit costs have been on the higher side. But they could, and the valuations of these banks are very, very attractive. So maybe the tier 2 banks in that segment, that in terms of returns, which you can make over the next 12 to 18 months, provided our hypothesis of credit growth pickup comes true, will be far, far superior than investing in the larger banks. Some of the larger banks now they're very well owned. So in percentage returns, if you're asking from today onwards, I think it's going to be the tier 2, tier 3 banks where the returns could be far, far superior. Mind you, most of these banks are now adequately capitalized. So it is not there that they require capital to grow. It's all about the environment being conducive for them to take that risk and increase their book.
All right. So earnings is going to be one factor that will drive share prices, individual sectors going forward. So if we talk about earnings, then I think IT really ruled the roost, because they've already guided for a double-digit growth in FY22. Do you think that's already priced into the share price that most of these big guys at least are commanding, but even the mid and the small cap IT names?
So this is one sector where the tailwinds were very strong, and we have seen some upgrades also in the earnings estimates post one quarter. My sense is that, yes, valuations wise, they are, most of the IT companies, whether it's tier 1 or tier 2 companies, are all quoting reasonably high versus their old averages. But I always believe that whenever a sector is in momentum, then it is foolish for investors to try to call the top. I think investors should continue to hold on to the stocks that they own, not knowing when the sector will top out. I think that is the better way of going about it. But having said that, the return expectations from here onward should be limited, or rather should be muted, because the valuations are rich. And that's the reason we believe that from here onwards, IT companies could possibly be low single digits or low double digits kind of compounders than anything else. It's important to have them in the portfolio, but putting fresh money over there, one has to be very, very vigilant.
KK, just wanted to talk about what's going on within the insurance space. I mean, as we speak, you've got HDFC Life acquiring 100% in Exide life insurance for about 6,687 crore rupees in part cash and stock deal. But just wanted to understand where within insurance do you actually find opportunities still? I mean, we all know and there is no debating the fact that this is a long-term growth sector. But do you think that this is also going through its transition and consolidation as well, perhaps as we saw in the case of HDFC Life?
I think in every business, what we see nowadays is that it's the bigger guys who keep on gaining market share, and the smaller guys are left unable to grow and have to possibly go in for an M&A, etc. So something similar has possibly happened in what you were mentioning about one of the private insurance majors acquiring a smaller company. So I think it's a very good consolidation which is happening, and you will see something like this happening in many more sectors. Having said that, I think the insurance sector, we all know the underlying positives in terms of the low penetration, the long-term opportunities. So these businesses are basically long-term compounders. They have had their challenges in the last 2 years owing to COVID-related excess provisions, claim, etc. being there. But yes, the top 2-3 names in the sector, they offer good opportunities. One of the insurance majors has gone through a lot of consolidation in terms of their business profile, etc. in the last 2-3 years. And maybe that's so individually you need to look at, is there any inflection point in one of these companies to pick and choose.
Sure. KK, Nikunj and I were just this morning talking about the platform companies and how digital really is the way to go forward. And any and every company with a digital expanse or a digital presence, the market is rewarding the same. Look at the year-to-date moves for the Jubilant FoodWorks. That's up 47%. India Mart up 15%, although India Mart has already moved up a lot from the 2020 lows. Emkay Global 40% higher. Angel Broking to 45% return. Bajaj Finance up 42%. ICICI Securities up almost about 65%. What are you making of how large this pie could get and how more and more companies could join in within this bouquet?
I think it's just the beginning. What you mentioned about some of these companies, yes, platform companies which are leveraging on technology, I think they will continue to grow far superior than the underlying competition. And there are only so many companies which are there in the listed space. So there will be a whole host of investors looking to invest in such companies. I think we need to understand that in India, investing is all about investing in growth. And all the companies that you were mentioning about and all the platform companies further which will get listed in the coming months, their growth is going to be phenomenal. And some of them are very profitable, some of them will take time to become profitable over a longer time frame. But as long as the growth is far superior than the average growth in the ecosystem, these companies will continue to attract investors and higher valuations.
So, is one better off, let's say, betting on a Bajaj Finance or a HDFC Bank, because these are existing banks and lenders which are becoming fintech? A classic example here is Jubilant, a pizza company which has become a food aggregator. Web of Gem and aggregator, a jewelry exporter, has now become a platform company. That's option that you look at existing companies which are changing avatar, or go for companies which are pure tech companies, like a Policy Bazaar when it will get listed, Nykaa when it will get listed. Which way one should go? Because these are companies which you want to have in your portfolio. The choice is best bet on the current ones which are changing, or bet on the new ones which are getting created.
So Nikunj, there is no clear-cut answer to this. I think it's not either or. It is possibly both, depending on which sector offers you that opportunity to invest in. So in fintech, yes, you have some of the listed plays which are also very technologically savvy and possibly can transform themselves into pure fintech plays. So that could be an opportunity for you to invest in a listed company. But some of the new listings which are happening are in space where there is no existing listed company available. Then you need to be investing into those IPO or whenever they get listed. So I think it has to be sector-wise. You will have to look at and understand their right to win, and then invest in such companies. Also, we need to understand is that what kind of competition, is it a two-player kind of a market, three-player kind of a market, or there can be many more players who can join who can give competition to that kind of in that ecosystem. So to value every company in that fashion, or to look at every company with the same yardstick would not be the right way to evaluate such companies. But having said that, I think a decent amount of your portfolio should be in this new generation businesses.
Where are the classic compounders headed for next couple of years? HUL, Nestle, I'm picking two staple stocks here, maybe in Asian Paints or Bosch. Where are these classic compounders which have created huge wealth in last 5 years? Where are they headed from here?
I think companies that you mentioned, they will continue to deliver decent returns to the stock owners. Point is that what kind of growth are these companies able to deliver, and what kind of valuation many of these companies have. We have seen cases where some of the stocks have languished or consolidated for years together. So maybe some of these, and now the breadth of the market is far, far superior than what it was, say, 2 years ago. So many of these companies have had a huge jump in valuations, and they have compounded very well over the last 10 years. So you could possibly see that some of these companies could consolidate and underperform the market for some time. I think we are all investing into growth, and to pay 50, 60, 70 times multiple for 10, 15% growth is possibly challenging for many fund managers.
So I'm just switching sectors here, KK. I mean, trying to get your sense on perhaps all the big sectors here. One stress sector right now is auto. Some are talking about terminal value going down because of EV. Some are saying that demand is not going to come back like last year. And there's another reason which you and me both know, and markets also openly discussing, is semiconductor shortage. Auto stocks are down 20 to 25% from the recent high. Markets are going higher, auto stocks are coming down daily. Is it time to buy the stress in autos?
So as per my understanding, if you ask me today, the pecking order in terms of our preference in the auto sector is one is, we start with commercial vehicles, then you go to two-wheeler, and then you go to passenger vehicles. So one is in the immediate opportunity, which is that the challenges from semiconductor shortage or chip shortage, the commercial vehicles are the least impacted, and the maximum impact is on the passenger vehicle segment. So this is from a short-term perspective. But if you look at the performance or the stock price performance of many of these auto majors in the last 5 years, they have been struggling. I think at the end of the day, the fear of what disruption will happen owing to EV, that's a bigger question. We have seen how the private VC-funded electric scooter company, the kind of size and scale that they are talking of, now they don't have to worry about public markets, they don't have to worry about earnings, etc. Can they disrupt the two-wheeler market? We don't know. But will investors be worried about how to value the existing listed companies in the two-wheeler segment? Possibly, yes. So we have seen something similar happening in the US also, where the market cap of Tesla is something like 45-50% of the aggregate market cap of all the auto companies. But the fact remains that they only manufacture only so many number of vehicles versus the number of vehicles manufactured by all the auto majors. So my fear is that OEM manufacturers' valuation would be under challenge I think it's better to play the whole auto sector through auto ancillaries. Because whoever wins, whether it is EV, whether it is ICE, whether it is, passenger vehicles or two-wheelers, auto ancillaries can possibly show far, far superior growth. And that is what we believe, that it is better to play the whole segment through large auto ancillaries, which have a very good domestic presence and have the ability to address the global market. So to address your question, yes, a contra investor could possibly look to invest in one of the passenger vehicle majors which is going through stress. But the fact remains that the EV threat is there for sure, and markets may discount that much more ahead before actually the EV becomes a reality.
KK, great to have you on the show as always. Thanks for taking the time out.
Much.
Okay, let's move on. Let's take stock.